Assalamualaikum warahmatullahi wabarakatuh. We are from Group 4 and we will present our discussion about winter company's transaction on January 2017. Before we get into the transaction, we will introduce ourselves. My name is Moza Aurora and my group members are Ghiran Muhajjalin and Amila Sholehah. So, in December 31st, 2016, Winter Company have the balance sheet, and in that balance sheet, cash have a balance 30,100, account receivable 19,780, allowance for doubtful accounts 800, inventory 9,400, accounts payable 8,750, owner's capital 32,730. So, during January 2017, the following transaction occurred. Winter uses the perpetual inventory method. So, on January 1st, Winter accepted a 4-month 8% note from Merando Company in payment of Merando's 1,200 account. So here is the journal entries. This is the date, January 1st, 2020. It's 2017. So, on January 1st, the account that occurred is note receivable and account receivable for Merando Company. For note receivable, the balance is 1,200 in debit, and for account receivable is 1,200 in credit. So the next transaction occurred in January 3rd, and the transaction is Winter wrote off as uncollectible the account of Inwood Corporation for $450 and Goza Company for $280. And we will write it on journal entries, which will lead us to 3 accounts that in this date, there are allowance for doubtful accounts, 730 on debit, and account receivable for Inwood Corporation, 450 in credit, and also account receivable for Goza Company, 280 in credit. So we move to the next transaction on January 8th. Winter purchased $17,200 on inventory on account. So in journal entries, we will write it as inventory, not purchase, because Winter used the perpetual inventory method. So the account that will occur is inventory with the balance of $17,200 on debit and account payable with the same amount on credit. Why is it account payable? Because on the transaction, we know that Winter purchased it on account, which is it will lead us to account payable account. The next transaction is on 11 January. And transaction is Winter sold for $28,000 on account inventory that cost $19,600. So we know that Winter uses a perpetual inventory method. So here is how we write it on journal entries. The first one is account receivable and sales revenue. From the transaction, we know Winter sold their inventory. It will increase the sales revenue, and we will put it on credit. Credit and account receivable on debit because Winter sold that amount of money, that amount of inventory on account. So it will give us account receivable on debit. The next one, because of this transaction, the goods on the inventory on winter company will decrease. So the inventory will be put on credit side. And for the debit side is cost of goods sold with the same amount of $90,600. So this is how we write it with the perpetual inventory method. And the next transaction is on January 15. On January 15, Winter sold inventory that cost $700 to Mark Leber for $1,000. Leber charged this amount on his Visa First Bank card. The service fee charged Winter by First Bank is 3%. And here is the journal entries. So because of this transaction, it will increase the Winter's company sales revenue for 1,000 on credit. Because Lover charged this amount on his Visa First Bank card and has service fee charge on it by 3%. So the cash that we will because of the service charge expense, we'll reduce the cash that we get from this sales. So we will get a cash for 970 on credit, debit, and service charge expense on debit also with the amount of money $30. Why is it 30? Because we multiply 3% with 100. So it will 30 and we'll reduce the cash for $30 too. And the other part of this transaction is it will reduce our inventory, right? So because like what I said before, we use perpetual inventory method. So we will write it with cost of goods sold with $700 on debit and inventory on credit with the same amount. Okay, for the next transaction is on January 17. Winter collected $22,900 from customers on account. And here is the journal entries. Because we get payment from the customer, it will increase our cash, and of course we will put it on debit side. So cash on debit with $22,900 balance, and on the credit card on the credit side we'll put account receivable for the same amount of money. And for the next transaction on January 21st will be explained by Raja. So Raja, time's yours.
Okay, thank you for the time, Moza. So I will explain the date of 21. The 21, the question was Winter paid 14,300 on account payable. The account was account payable on debit 14,300 and the cash on credit. So, and the next was date of 24. Winter received payment in full 2,080 from Goza Company on the account written off on January 3. As we can see on January 3, that was already on the write-off, so we must to make in again to the account receivable. So we add it again to account receivable. We put it on account receivable and debit, and we put it allowance for double account on credit. Then we put it again on cash as a debit and account receivable on credit. And the 27 winter purchase supplies for 1,014 cash. So the account is supplies on debit 1,400 and on credit was cash 400. And the last on journal entries was is winter paid other operating expense 3,718. So the account other operating expense on debit and the cash on credit. Now we move to adjustment data. The number one is internet is recorded for the month on the note from January 1. As we can see on the January 4th, January, on that one, on the journal entries, Winter accepted a 4-month 8% note from Merando company in payment of Merando 1,200 account. So how to find the interest receivable? We can how to find the interest? We must to multiply the 100 to 1,000, multiply 8%, then we divide we divide 12 because that was still 1 month. So we get the interest receivable is $8 and interest revenue $8. Interest receivable on debit and interest revenue on credit. And the number two is bad debts are expected to be 6% of January 31, 2017. Account receivable. Moza, can you see on the account T on the account receivable, please? As we can see on the account receivable, the balance are to 22,950, and the allowance for double accounts, the balance are 1,077. So how to find it is the account receivable must to multiply 6%. Sorry, I mean account receivable 22,950 multiply 6%. Then we can see on the journal entries, there was a balance before the adjustment is 800. Then on the day 3 winter already make the allowance for double accounts is 7,030, and the 24 winter receivable payment is in full 2,080 280. So we must 800 plus 2,080, then we minus it to 7,383. 730. Sorry for mistake. Then we minus it. And we get 1,027. And the account is bad debt expense on debit and allowance for doubtful account on credit. The adjustment data on number 3, account of supplies on January 31, 2017 reveals that 560 remains unused. So the supplies expense, how to find the supplies expense was the balance of supplies expense, we minus it on 560 and we got 840. The account is supplies expense on debit and the supplies on credit. Thank you.
Thank you, Raja. And we will move to trial balance after adjustment. So in here, it's pretty simple. We just have to put every single balance and on every single account, which there may be on debit side or credit side. So on January, 2017, the cash balance is $17,832 on debit, note receivable for $1,200 on debit, account receivable $22,950 on debit, allowance for doubtful account $1,377 on credit side. The next one is interest receivable for $8 on debit side, inventory also on debit side for $6,300. So supplies on debit for $560, account payable, owner's capital, sales revenue on credit with the amount of money for $11,650, $32,730, $29,000. Next one is cost of goods sold. On debit side for $20,300, supplies expenses for $800 on debit, bad debt expense $1,027 on debit, service charge expense $30 on debit, other operating expenses on debit also for $3,780. Interest revenue on credit side with the amount of money for $8. So the total amount of balance is $74,765 on debit and credit side. So the next one is prepare an income statement, owner's equity statement, and balance sheet that will explained by Amila. So Amila, time's yours.
Thank you for time. Before I explain income statement from intercompany, I will explain what is income statement. An income statement is the one of the three major financial statements along with the balance sheet and the cash flow statement. They report a company's financial performance over specific accounting period. The income statement focuses on the revenue, expense, gains, and the losses of company during a particular period. So, in winter company, this is the income statement. First, we have sales. Sales revenue is 29,000, and the cash cost of the goods sold is 20,300. That minus from the cost of the goods sold, so we get the gross profit is 8,700. And operation expense, we have many expense. First is supplies expense, 840, and that expense 1,027, and service charge expense 30, and other operation expense in 3,718, and the total of the operation expense is 5,615. And gross profit minus from the total operation expense, we get the income from operation is 3,085. And there is other revenue engines. We have the interest revenue is 8, so the total from the net income is 3,093. The second, we have the statement. The second is statement of equity change in equity. also referred to as the statement of the retained earnings, is a business financial statement that measures the change in owner's equity through the specific accounting period. It covers the following elements: net profit or loss, dividend, and the payments. The first is owner's capital in 31 December is 3,093. The 32,730 and net income 3,093 and we push the owner capital and the net income. We get the owner capital in 31 January is 35,823 and that is the total from the owner capital. And the last is balance sheet from intercompany. Balance sheet is a financial statement that contains detail of the company's asset or liability. A balance sheet is a financial statement that contains detail of a company's asset or liabilities at the specific point in time. It's one of the three core financial statements used for evaluating the performance of the business. In the left set we have left apa tadi? Left kanan kiri. Left kiri. In the left set we have Activa. First account in Activa is cash. So cash have 17,382 and notes receivable 1,200 and account receivable 22,950 minus from the allowance probable account 1,377 and the total from account receivable 21,517.3 and interest receivable 8, inventory 6,300, then supplies 560, and the total from asset is 47,473. And the right side we have the passiva. Account payable is 11,650 and owner's capital in 31 January is 35,823 and the total from liabilities and equities is 47,473. And that's all from me for the question number C.
I think that's all for today's discussion about winter companies in section on 2017. Thank you to Mila and Raja. And I think I will end this discussion with Assalamualaikum warahmatullahi wabarakatuh.